Mark Conn, Chief Executive Officer with Cathy Conning Asset Management, that's CCAM, joins us live from Hong Kong. Mark, good morning. Thank you for joining us.
Good morning.
Mark,
my pleasure.
The stalemate between US lawmakers, it still continues. The economic news from China is still uneven, and European bond yields have gone up. So there is clearly a nervous environment around us. But despite so much of nervousness, developed markets are still holding on. Is that strength or complacency?
Well, certainly the concern that you might have expected in terms of the stalemate in the US over the budget and the need to raise the debt ceiling, that level of relaxation in the markets is somewhat surprising given what we've seen in the past. So I think that the markets are telling us is that they do expect to see a deal brokered at some time before the deadline. And overall, the news flow up until that point had been broadly positive. If you recall, there was expectation of tapering from the Fed in the US, which did materialize. And we have seen for the third quarter, certainly, and going into the current quarter, we've seen slightly stronger economic news coming out of China, suggesting that the economy is now stabilizing. So these sort of former trends are still playing out in the absence of any serious concern over the debt discussions in the US. And we saw yesterday the ECB have kept rates on hold as well, which will support equity prices a little bit further.
Mark, hi, morning. In the last two trading sessions, we've seen stark outperformance when it comes to emerging equities, and that includes the Asian pack as well. Do you think in the near term, whilst the stalemate in the US continues, all markets except US are going to outperform because people are a little cagey about how to go about approaching US equities?
Well, I've heard that in the last couple of days that with the US sort of locked in stalemate over the budget discussions, maybe money will flow more to overseas markets. I doubt if that is a sustainable trend, whether a trend at all. I think what we're seeing now is a little bit of a recalibration as there was a pullback from emerging markets and the run-up to the previous Fed meeting, really from the end of May up until the last Fed meeting. Investors have been quite cautious of certain emerging markets, certainly those dependent on commodity prices and those running current account deficits. Currencies came under a lot of pressure and markets themselves came under a lot of pressure, to the point where I think investors feel that probably that correction has been overplayed and there's an opportunity now to come back in and pick up stocks at prices that are relatively attractive at a time where probably the decline in the currencies has probably been exaggerated a little bit on the downside. So I think that we're seeing a little bit of that, of a re-entry into the markets, but I don't think it's a sustainable trend, and in many ways it's unrelated longer term to what's going on in developed markets.
Mark, the other talking point, of course, is that the partial shutdown in the US government also delays tapering, because a lot of people were talking about tapering to come in perhaps in October or December, and that as well gets pushed.
Yeah, I think that is definitely a factor weighing on investors' minds. It's widely believed, and I think correctly, that for as long as there is this standoff in Washington, that the Fed will hold off from tapering. But aside from this standoff, which markets are expecting to be resolved, we would expect to see tapering back on the agenda at some point before the year end. The Fed will continue with its plan to slowly pull back from its intervention and its stimulus, on the assumption that we continue to see improvement in the underlying economic picture. And the Fed have made it very clear, Bernanke's made it very, very clear, that any timetable to pull back from tapering is wholly dependent on the progress of the real economy.
Well, Fed indeed is data dependent, and if the stalemate for US economy continues, well, there is no data on which they can base their opinion. So, Mark, can I safely assume that for next 6 months, the emerging market party or the risk-on rally will continue?
Yes, I think that is correct. I think there's continued to be overall a bias towards developed markets, but I think from time to time we are going to see a reallocation to markets selectively in the emerging market basket. However, I think some of the structural issues that weren't addressed in the previous cycle will now need to be addressed in this region. As we know, India in your market and also Indonesia are prime examples of that. Some of the structural reforms that need to go in place will need to be, progress will need to be made in order for investors to feel confident to come back in. So I think at the moment it's not necessarily an issue of valuation, it's more about confidence in feeling that some of these structural issues are addressed.
Mark, really appreciate you taking the time out and speaking with us today. Good chatting with you as always.